Hey, gang, it's Friday, August 14th. Time for reviewing the events impacting mortgage rates this week and why it matters. The latest economic data just gave us a pretty interesting picture, and mortgage rates are caught right in the middle of it. First, the good news: inflation is cooling. Both July's consumer and producer price index figures came in lower than expected, adding to signs that inflation is slowly moving lower. And last week's big development, more signs of a weakening jobs market. The economy actually lost 23,000 jobs in July, and previous months were revised by more than 103,000 jobs. Wage growth also slowed. Put these together, cooler inflation and a weaker jobs market, and the case for the Fed to raise rates is diminishing. As a matter of fact, the probability for a September rate hike sits just above 30%. A month ago, it was above 50%. Overall, this is good news for the bond markets. But here's the catch: longer term rates are telling a different story. The government just sold 30-year Treasury bonds with the yield at 5.22%, the highest level since 2001. Investors are demanding higher returns because the government is borrowing so much money. Our national debt just surpassed 40 trillion. And finally, consumers are showing some weakness too. July retail sales fell 0.6% when economists were actually expecting to rise. Where our 30-year conventional rates, they're still hovering in the 6.5 to 6.75% range. We've been in this range for about 4 months now. So the big takeaway is that the Fed may have less reason to raise rates, but currently that's not pushing longer-term products lower like 30-year mortgages. Thanks for watching. Let me know if I can answer any purchase or refi questions, including reverse mortgages, and have a blessed weekend, everyone.